I'd like to welcome everyone to the New York Alternative Investment Roundtable monthly call for February 2021. I'm Robert Atkinson of Riverside Management Group, the moderator. We are very pleased to have our good friend, Mark Yusko of Morgan Creek Capital Management, join us once again. Mark, as many of you know, is the CEO and Chief Investment Officer of Morgan Creek Capital Management and the managing partner of Morgan Creek Digital Assets. Morgan Creek Capital Management was founded in 2004 and currently manages close to $2 billion in discretionary and non-discretionary assets. Prior to founding Morgan Creek, he was CIO and founder of UNC Management Company, the endowment investment office for the University of North Carolina at Chapel Hill. Prior to that, he was Senior Investment Director for the University of Notre Dame Investment Office. Mark, over time, has been at the forefront of institutional investing throughout his career. The endowment model is the cornerstone philosophy of Morgan Creek as the mandate to investment in innovation. He's again at the forefront of investing through Morgan Creek Digital Assets, which was formed in 2018. Morgan Creek Digital is an early stage investor in blockchain technology, digital currency, and digital assets through the firm's venture capital and digital asset index fund. The title of Mark's talk today is The Future of Finance, Trends in Fintech. And I just want to point out to our audience that during the course of 2021, the roundtable will be paying special focus on fintech, and we can think of virtually no better source than Mark Yusko to really help us set the table and provide us with the big picture. But before we dive into this very interesting and relevant topic, I do want to thank our sponsors for their ongoing support of the roundtable and this call. They include, and they're right in front of you on the screen. Thank you, Britt. They include Alston Bird, Baker Tilly, Bloomberg, Deloitte, Grant Thornton, New Mountain Capital, Murray Asset Securities Prime Brokerage, and of course our nonprofit sponsors, Kaya, United Kingdom Department of Trade, and the Grand Duchy of Luxembourg Trade and Investment Office. Just a reminder to everyone, Mark will be answering my questions for approximately 45 minutes. And then we're going to open it up to the audience as we typically do. But I also want to call to your attention the fact that at any time during the call, you can send questions to me for Mark by using the tools at the bottom right-hand corner of your screen to send questions in. So by all means, please feel free to do so. One other programming note that I'd like to call to your attention before we begin, and that is that the Roundtable and the Connecticut Hedge Fund Association will be sponsoring a discussion on the ongoing fallout from the GameStop trading frenzy and its potential to disrupt short selling, brokerage commissions, and trade settlement on February 26th at noon to 1 p.m. So by all means, please join us for that event and check our website for more information. So Mark, again, welcome, and let's get started.
No, thanks, Bob.
Fintech, it's a phrase that we hear quite a bit these days, and for good reason. And I don't think it can be said that it's a technical term. It's really used more in common parlance. And I think it might be useful to hear from you what you mean by fintech, just to provide an overall framework for the conversation to follow.
Yeah, I don't want to spend too much time on definitions in the sense that it really is just that intersection of financial services and technology. And the best way I think about it is I have this chart in one of my presentations. It basically shows a bank in the middle of it, and then all these lines and all these other things basically attacking that single cell organism. And I basically say, look, the banks have been under assault for decades from technological solutions that are trying to disrupt their ability to be basically monopolies or oligopolies. And that's really, to me, what fintech is all about. It's that seamless transition from, the analog world, right? The old days, we had a physical piece of paper. We had a physical stock certificate. We met under the buttonwood tree down at Broad and Wall, and we exchanged. And then they're like, we should probably go inside because it might rain, or thug might steal our stuff. So we'll go inside and we'll build an exchange. And then it was like, these paper things, they get lost, they get stolen, they get spilled on. Hey, let's electronify them, and let's put all the paper at DTCC in Dallas. And that sits in file drawers, and now we have QSIPs. Well, now we're migrating to the digital age, and that transition from fintech to digital assets is really pretty incredible.
I think that's really well said, Mark. Thank you. And I think we could probably agree that the primary sectors of fintech, would include, as you said, banking. Yep. We'll expand it to include investments, yep, insurance, payments, financing, and of course, financial infrastructure. So could you spend a moment maybe talking about these different sectors and give us some of the highlights today and where they might be heading, please?
Yeah, look, to that point, we can break down the landscape into these different geographic regions, like geography on a globe, but they are more interconnected. In fact, think about the line gets blurred in this term financial services, banking, insurance, who provides what, brokerage services, trading, but all of those services that were once done in the traditional or the TradFi world, are now migrating into this digital age. And there are solutions around everything from platforms and banks. You and I were talking before the call. Think about a place like Africa, right? The average person, right, doesn't actually have a bank account. More people don't have bank accounts in Africa than do, but almost all of them have a mobile phone. And yes, if you provide financial services, can't call it banking services because they don't have a bank, they're unbanked. You provide financial services to those people through the mobile network. That's really interesting. And M-Pesa, one of the great innovations of our time, where you can trade mobile minutes like money, because they're a form of currency. So, that transition from, before I got on this call, I was talking to a friend, and we're going to do a large scale production, think billions in the crypto world, a streaming show. And where we're going to film it, it's really interesting, is a giant mint, or part of the Federal Reserve in San Francisco, that's been decommissioned. And now they need to rent out the space to pay electricity. And you can go to Cipriani in New York, and it's a giant, beautiful old bank building. So the days of these big, temples of finance are gone. And now what we realize is, I asked the question, do we actually need banks at all? Do we physically need branch? I haven't been in a branch bank, and I did the other day to get a notary to sign something, but I haven't been in a bank to do a banking service in forever. And that's interesting. Investments. Investing used to be, right, the moneyed set, many of them linked to banks. And then people spun out of banks and trust companies and set up asset management firms. Well, now we've got a digital revolution that's taking all of those investment services and bringing them into this fintech landscape. Insurance, right? The old days of Lloyd's and a bunch of guys, they were all guys, no women back then, sitting around a room and deciding which risk was good and which wasn't. All that can now be done electronically, ultimately digitally, and ultimately, I think, with smart contracts. Forget people, forget syndicates. It's all going to be done, I think, in smart contracts. Financing, again, in the old days, we had what was called hedged finance. The banker knew you. He lived in your community. Again, it was a he, and it became he or she. But the banker knew you, and they only lent you money where they believed that you could pay back principal and interest. Then we moved into speculative finance, where the banker no longer lived in your neighborhood because it got, small bank got bought up by the big national bank. And now the banker was someplace in New York or LA or whatever, but they kind of could get to know about you. And they would actually lend you money, hoping that you would pay the interest, knowing that you could never pay back the principal. And that was speculative finance. Well, then we went into the age of Ponzi finance, where we are today, where people lend money. They're nameless, faceless institutions. Nobody knows who owns their loans anymore. They get chopped up and sliced and diced and sent off in this electronic morass that we have of securitization. And there is no relationship with that bank. And what's worse is they'll lend you money hoping that you're just going to flip the asset and you can't pay principal or interest. So that's a bad situation. But ultimately what's happened is electronic and ultimately digital solutions have come up through this world of fintech. And there is now peer-to-peer lending. You get a mortgage today. You don't go to the bank. When I went to get my first mortgage, again, you and I are, same age cohort. And I went into the bank and I said, I'd like a mortgage. And they said, well, if you deposit $100,000 with us, we'll lend you $100,000 for the mortgage. If I had $100,000, I wouldn't need a mortgage. And then the second iteration, when I later in life, I went to a financial services, a mortgage company, Countrywide, the
Sure.
old man. And before
I remember the commercials.
Before I got in bad trouble. And they didn't know me from Adam, but they made me a loan. Now you can go to Rocket or any online service, fintech oriented service. And I'll give you a great example. So one of our biggest investments in our venture fund, which by the way, that was a great intro. It's perfectly summarized, succinct, loved it. But our biggest investment, actually now second biggest investment in our venture fund is a firm called Figure Technologies. And they do two things. One, they're a home equity lender, and they have taken a home equity line of credit, used to take 60 to 90 days. They do it in 5. They tell you if you're approved in 5 minutes, not 5 days, no paper. They literally sign on to the API of your bank. They decide whether you're a good risk through AI and predictive analytics. Boom, you're approved or not in 5 minutes. And in 5 days, the money is in your account. Unbelievable innovation.
Yes.
So that's a pretty interesting business. The second thing they do is they have built the blockchain equivalent of DTCC. And DTCC, here's an amazing stat, processes $1.8 quadrillion a year. That's a lot of zeros.
That's a big number.
Quadrillion.
Yeah.
And it's owned by the banks and they get a little dividend and they're really happy that it exists. But the average person doesn't really appreciate that if you have a stock, you don't own that stock. It sits, the physical certificate sits at DTCC. It's in the street name of the brokerage firm. You have an IOU from the brokerage firm. Most people have no idea. It's like when you put your money in a bank, it's not your money anymore. It's the bank's money. And you have an IOU that in most cases is good, but can be expropriated from you. So
it's
all
been
this
dematerialized and immobilized.
Yeah. What's interesting is what Mike Cagney has built. He was the founder of SoFi, left to found Figure. He's built the digital equivalent of DTCC. That could be a really big business. So
Mark, can I ask you a question?
Yeah.
This is really an interesting point, because if I'm understanding it correctly, look, we take for granted that stocks, right? Equity securities can be treated, ownership can be exchanged the way you described, and using the DTCC in the middle, okay? But what you're talking about is expanding this whole process of financialization to include assets beyond securities.
Amen. Yep.
Hard assets,
every
real property.
Every asset, a big statement. And I'm prone to big statements. I'm a dutiful firstborn, but I'm also a hyperbolic personality. And one funny story. So my wife has only seen me speak one time. She came to Vegas for one big event we were doing. And at the end of the talk, she said, "Mark, you can't say things like that." Like what? She says, "You say things so forcefully." I'm like, well, what's wrong with that? She says, "Well, people will believe you." I'm like, well, that's the whole point. She says, "Well, what if you're wrong?" I said, "I'm wrong all the time. I'll change my mind." So the key is that hold on a second. I can let my dog out. The joys of working at home.
Understood, Mark. Absolutely. Take your time.
Sorry. No. I mean, her whining in the background is not pleasant for everybody on the call. But this idea that, we live in an analog world for most of life, and analog meaning little physical piece of paper. One piece of paper is money, one piece of paper is a stock certificate. We exchange that. Great. Then we went to electronic QSIPs, which are much more secure, but there need to be trusted third parties and intermediaries. And what fintech is all about is disrupting or blowing up that intermediary. And the big statement I will make is that every stock, every bond, every currency, every commodity, every piece of real estate, every business, every asset, everything will be digital, will be fully digitized, and fractional ownership will be possible. It will trade 24/7 globally, borderlessly. Nation states will have a very different role going forward. And I had this epiphany over the past 7 years when I first got exposed to this idea of what blockchain technology is and crypto. And what I have come to realize over that journey is this is the biggest wealth creation opportunity any of us will see in our lifetimes. It is the greatest innovation of the past century. And it's going to change everything the same way that the migration from single entry accounting back in the 1100s and 1200s to dual entry accounting from the 1200s to the 1800s. Now with triple entry accounting and the expulsion of that trusted third party and all of those intermediaries. I mean, think about a bank loan. Many people here work in the world of bank loans. It takes 30 days to settle. Are you kidding me? A stock transaction takes 2 days to settle. How can that possibly be in the digital age? Well, it's because there are a lot of intermediaries and a lot of interested parties that don't want that to go away. There are 7 legacy systems to settle a bank loan. 7? No, we need one. We need one digital solution, and we can settle instantaneously. And that's what provenance, what Figure's blockchain can do. So anyway, that's a long answer to a simple question.
No, I think that's terrific. And that takes us right into, and I think you've already entered it, but the space of financial infrastructure. Let's talk about that for a moment. What do you see? And I thought your comment about the application of the DTCC model for other asset classes, a very interesting one. But if you would, let's get a little more into blockchain and financial infrastructure platforms, and your statement that, or question rather, but I think there was also a statement embedded in there about why do we need 2 days to settle a trade?
Yeah, look, it is a very interesting technological evolution, not revolution, not scary, but just a simple evolution of technology that we are in the process of. And the best way to think about it is blockchain is an operating system.
Yeah.
Right? It is the operating system for the internet of value. So the important thing here is we've been on this technological evolution for about 70 years. And it started with mainframes in 1954. 14 years later, we had this innovation around microchips and we had mini computers. 14 years later, I haven't figured out why it's always 14 years, but it's always 14 years. 14 years later, we had the personal computer. And the personal computer, I grew up in Seattle. A lot of my friends don't work anymore. They went to work for Microsoft, smarter than me. I would say, I defend myself by saying, if you've ever seen the picture of the original Microsoft 7, you wouldn't blame me for not working with those guys. They looked a little rough. Although we all looked rough in the 70s. It was not a good fashion time. But Steve Ballmer's mom said, honey, why would you work for that company? No one would want a computer in their house. Here we are talking in real time on computers in our house. 14 years later, 1996, the internet. And Paul Krugman said it would never be more important than the fax machine, maybe a little more important.
Sorry, Paul Krugman said that?
Yes. Yeah, that the internet would never be more important than the fax machine. Maybe a little more important. 2010, the mobile net. And I remember being back in Seattle at Craig McCaw's house for a venture capital gathering, family offices. And I asked his family office guy, do you think the mobile net is going to be as big as the internet? He's like, Mark, are you kidding me? Ask me if they want a computer. I'm like, yeah, whatever. Ask them if they have a phone. They said, well, I already have two. Oh, my other one's up there. I already have two. I probably don't need another one. So yeah, it's going to be bigger. And today we have over 10 billion connected supercomputers in our hand that create a network effect that's unfathomable 20 years ago.
But isn't one of the key points,
2024?
Mark,
no, that's point. 2024. So 2010 was the mobile net. 2024, which is still 3 years from now, is the internet of value, or is what I call the trust net. And that is where blockchain as an operating system. So go back to COBOL and Fortran for the mainframe, then, Sparks on workstations. Then you had DOS and Windows for the personal computer. Then we have TCP/IP for the internet. Then we have iOS and Android for these babies. And now blockchain is going to power the internet of value. And look, value over internet protocol is the new VoIP, right? Voice over internet protocol was a big deal. Value over internet protocol is the greatest invention of this millennia. That's a big statement, but it's a monster innovation.
100%. And the only point I wanted to make was how essential protocol is. If you can't agree on the protocol, none of this works.
No, and Bobby, it is the great insight of this transition, which is protocols have been around for a long time, right? Everything's about protocol, right? That you have to have a standard or an accepted system to exchange anything, whether it was, puka shells or
Sure.
Easter Island heads or whatever it was, but you have to have a protocol and a reason for exchange. And so the internet was built on a series of protocols. In the 70s and the 80s, there were about 80 protocols. Today we have 5, right? There's TCP/IP at the base layer. Then there's SMTP for email. There's HTTP for web. There is FTP for file transfer. And then there's www. Which is kind of like the glue that brings everything together. Fast forward to today, okay, blockchain has born protocols, and there's dozens of them out there. Today, the one that matters most is Bitcoin, which to me is the TCP/IP, the base layer. On top of that is Ethereum, which is really the www. Of the internet of value. And then there'll probably be 3 others. FTP, file transfer protocol, is basically like FTP. Filecoin is like file transfer protocol, so that works. And then there's probably 2 or 3 others that will emerge. But that protocol stack, the thing that is so intriguing and why I get so excited about fintech and about blockchain technology and the future of finance is, in the old days of tech, that transition to protocols and the internet, back when Katie Couric and Brian Gumbel on the Today Show, 1996, what is internet? What is that at symbol? And remember, pets.com blew up because it was a terrible idea.
Yes.
Chewy.com is the same damn company, and it's worth $20 billion. Pets.com and Chewy.com are the same. The difference is we didn't have the infrastructure. Back to the whole point of infrastructure. We didn't have the infrastructure to make it work, but the idea was the same. Same thing with Netflix. Netflix in 1998 was a horrible company. It was a horrible business model. Sending discs through the mail didn't work. They got broken, they got stolen. Then they changed to video on demand. Well, that was a worse idea because it took 4 days to download a feature film. No one's going to wait 4 days. So today, instantaneously streaming, it works, but we needed broadband. And it was broadband, not the adoption of the internet, but it was that infrastructure building on top of the technology. And again, that's this merger of financial services and technology, fintech, that gets so exciting, because what what the internet did to media, right? Think of ABC, NBC, CBS, right? You and I are old enough to remember running home to get at your TV tray so you could be in front of Happy Days at 8 o'clock on Tuesday night. And then Laverne and Shirley, and then Joni Loves Chachi, and whatever. Horrible shows, but that's what we did. And they controlled our eyeballs. They controlled our spending habits. And they were incredible businesses. All their market cap, gone. It's in Netflix. How does that happen? Because Netflix disrupted that media empire by adopting better technology and a better business model, subscription revenue. And so the same thing's happening in financial services. And what blockchain will do to financial services as we know it is akin to what internet did to media and communication. So if you think about the size of financial services around the world, we're talking trillions, tens of trillions.
Yes.
Just on the back office savings alone. WEF projects that integrating blockchain could save 7 trillion. And I say, we all say the T word like it's nothing, but right. 1 trillion means we all have to sit here, all 67 of us my eyes are going bad. So how many people are on this call? Yeah, 57. All 57 of us have to sit here for the next 31,710 years and spend $1 a second. That's $1 trillion. So if we can save 7 trillion of bad, wasted costs out of financial services by migrating to fintech and blockchain solutions, that's an extraordinary opportunity. Put a multiple on that and you're talking real money.
Mark, to take what you're describing maybe to a logical conclusion, could you say that as we apply technology using the blockchain, as you say, okay, to financialize, right? We're financializing more and more, right? Does that result in money becoming less important? Money as a store of value?
Yeah, well, that's a really great question. Money has, in the last century, gone from being a pretty decent store of value to a horrific store of value. And what happened was in the olden days, right? We're talking millennia. And really, it's, for 5,000 years, an ounce of gold has bought a fine man's suit, right? From a suit of armor to a suit during the American Revolution to a Savile Row fine man's suit today, 1 ounce bought a fine man's suit. So real commodity-backed money, whether that was gold, silver, copper. Remember, during the Roman Empire, which lasted a long time, a solidus, which was a copper coin, was the most powerful currency in the world, a perfect store of value up until a point, and I'll explain that point. And what was interesting about it is the word solid, right, comes from that term, and it meant citizen. You were a solid citizen. You were a citizen if you had a solidus. Well, what happened is as the government became cronyist, right, with an emperor or / dictator and putting their cronies at the top, they concentrate the wealth and they profligate get spend and incur a bunch of debt. Well, then what they do is they literally deface the currency. So what they would do is they would literally carve the edges of the coins.
They were clipping the coins.
They clipped the coins, which is why you have the little ridges on a quarter now, right? And so the issue is the governments, once they get in power, and they're in power for a long time, and you become a career politician, you will spend. Because I always say the reason is an entitlement. An entitlement is something, it's a promise you make to yourself that you don't fund and you ask your kids to pay for. And so everyone would vote for that. And so that's what governments do. And so every empire has fallen in history, every single one. And it's because of debt. And that debt is what causes you to devalue the currency. So money from 1776, the founding of the Republic, to 1913, a dollar, which was originally dolar, which we stole from Holland, a dollar was worth a dollar. It has a little fluctuation around two big wars, Civil War, a little conflict.
Yes. Yes.
But basically it was worth a dollar for that whole period. From 1913 to today, as Jay Leno said, there's a rumor that the Fed is going to create, or the Treasury is going to create a dollar coin. Well, they already have. It's called a nickel. And so we've destroyed the value of our currency through devaluation, through this concept of inflation, inflation is simply a wealth tax on the poor to the rich. It's reverse Robin Hood. It is a horrific thing. The idea that we have a 2% inflation target is nonsense. And it's always been the plan to concentrate that wealth at the top. And it's why we have the greatest wealth and income inequality in the history of mankind today. That's the plan. And so what moving back to hard money, whether that be gold, whether that be silver, or now Bitcoin is the hardest money there is. Why? Well, because it's the most scarce. Scarcity is what creates value. Anything in surplus, supply and demand, right? If there's excess supply, price falls. When there's limited supply, price rises. And if demand increases for a limited supply asset, price escalates very quickly. And so if you think about money has been engineered to be a destroyer of store of value. It's designed to take wealth from the owners of that money.
Well, do you mean hard money or fiat money?
Fiat money. Fiat money. Fiat money has been engineered to push wealth up the food chain. Whereas hard money,
about that. Yes.
Gold, silver, collectible Porsches, right? Best performing asset in the last 10 years, even better than Bitcoin. Why? Because there's only three people in the world that buy them: Jay Leno, Jerry Seinfeld, and John Shirley, the number 3 guy at Microsoft. And they will pay whatever it takes to get those collectible Porsches. And why are Porsches so rare? Again, scarcity. It's because of the dentist wrap phenomenon. Dentist goes out and buys, I shouldn't pick on dentists, but it's what they call it. The dentist buys the Porsche, thinks they know how to drive them, accelerates into a turn, which you should never do, and wraps it around a tree. And now there are fewer good Porsches. So the ones that survive the dentist wrap phenomenon become scarce and they become very valuable. Well, Bitcoin, as of the last halving, has now become the scarcest asset on something known as stock to flow. If you think about any asset, take real estate. Real estate is a good store of value because the new flow in any one year relative to the existing stock is very low because some real estate wears out and is torn down. New stuff is built, but the increasing flow relative to the stock is very low. So the stock to flow ratio is very high. Gold is right behind that because what's lost or stolen in gold versus what's produced. But Bitcoin, as of the halving, now is the most scarce asset in terms of the new flow, the new coins that are minted every day relative to the existing stock is very low. And that means as increasing demand, as more people like Michael Saylor put it on their treasury or Elon Musk buy some for a publicity stunt, but as more of us as individuals say, I need to take some of my wealth and opt out of the fiat system, the demand.
Okay. So let me jump in here and ask you a question. You've said a lot of really interesting things here. And the comment you made about the government's role in all this, right?
Yeah.
And juxtapose that with the comments you just made about Bitcoin, how Bitcoin is really the digital gold. Those are my words, not yours. So at what point does the government say, you know what? And one thing every government on the planet has in common, despite politics or anything else, is they seek to have a monopoly, in fact, do have a monopoly on the local fiat currency.
Yeah.
So Bitcoin, et cetera, even financialized assets, in a sense, that can be traded directly, right, peer to peer, okay, that don't require exchange of shares for money, represent a threat to the monopoly of those jurisdictions.
100%.
So at what point do the governments of the world, I mean, not collectively, I'm sure, but individually step in there? I mean, I think you and I have talked about this before. My own view is that, electronic money will become the coin of the realm when it's Fed coin.
Yeah.
Not a private money. What do you think about that?
No, look, so it brings up such an important point. And again, back to, the future of finance and fintech, it's all interrelated in that there is no question that every currency in the world will be a digital currency. And you notice I didn't say cryptocurrency. I have this great chart, and it basically shows gold for 5,000 years. And then in 1973, the conversion from hard money to fiat. And then the fiat starts to go down, and crypto, which started in 2009, starts to go up, and they make an X. So ultimately, crypto, hard money, will displace all of the crappy money. So over the long term, there will be more wealth stored and saved in hard money cryptocurrency than in fiat. But fiat's not going to go down without a fight. And why is fiat so interesting right now is it will transition to digital, right? A digital currency, a digital government currency, whether it's FedCoin or the first one is the digital renminbi. Now, there was a rumor, and I have not confirmed this yet, but during Lunar New Year, Chinese tradition is you hand red envelopes with money to friends and family. And there was a rumor that this year the central government was going to hand out some red envelopes with a QR code with digital renminbi. Unbelievable. If they actually have it and it works,
yes,
they will be first, and they will create an amazing assault on the dollar's hegemony around the world as the world reserve currency. Because the reason we have the world reserve currency today is because, we signed the treaty in 1944, but more importantly, in 1973, we signed another treaty that most people don't talk about with Saudi Arabia, and basically said, here's the deal. We will protect you at all costs so long as you denominate every oil transaction globally in dollars.
So the petrodollar.
Anytime someone threatened that, right? Gaddafi said, I'm going to price in euro, he disappeared. Gaddafi said, I'm going to price in gold, he disappeared. Anyone who threatened that, you were an enemy of the state. And, you weren't as smart as Gene Hackman, so, they caught you. And great movie, by the way, great movie. Love that movie. And so if you think about that, what the Chinese are doing, and I say this all the time, China's playing Go while the US argues about how to set up the checkerboard. They're playing a different game. They're thinking long-term. They're way ahead of us in many respects. And this is one they're way, way, way ahead. So they are much further down the path of adopting a digital renminbi, because here's the thing. If you're in Venezuela and Maduro and his cronies have taken all the wealth to the top and they're devaluing the bolivar to steal your wealth, you have a choice. You can go out in the black market and you can go find dollars, which some people did. They exchanged their bolivars for dollars. But you can get shot doing that in the back alleys. Or you could go online and you can exchange for Dash, which is actually a pretty cool currency that has been popularized in Venezuela. Or you can buy Bitcoin. Well, it's harder and mostly local Bitcoins. Again, tough to do that in the back alley. But if there's a digital renminbi, you could buy that. Now, maybe not all at once, but ultimately, the Belt and Road Initiative that China's doing, where they're basically rebuilding the Silk Road, and they're financing all these projects all over India and Pakistan and the Stans all the way to Europe. The reason they're doing that is they ultimately want the renminbi to be the currency of the realm. And it's a long-term plan, right? It's not going to happen tomorrow, but it's going to happen. And so today, 8% of global trade is with the United States. 60% of global transactions are denominated in dollars. That number's going down. That number's going down. And today, people say, well, Bitcoin's not good because it's not used for transactions. That's not the point, right? I don't carry around bars of gold and use it for a transaction. In fact, another one of my favorite movies, Heath Ledger, Knight's Tale, is he wins the tournament with the sword and he gets this calf made of gold. And his, squire has gotten in trouble with gambling, and he literally bangs the calf down and says, breaks off a piece and says, go do what you do with this. Melt it down, whatever. Well, that's a really bad way to divide that asset. Right? It's not very precise. And gold is heavy and not transportable. And I say, and all the gold in the world fits in 2 Olympic-sized swimming pools, about 3 times the size of my library here. And all the Bitcoin in the world fits right here. Now, I actually don't have all the Bitcoin in the world. In fact, I don't have any on my phone. So anyone thinking about SIM swapping me, don't do it, because I don't keep it on my phone. but I've actually been SIM swapped twice, people thinking they could steal Bitcoin. It's just such a hassle. Oh, by the way, anyone who does two-factor authentication with a phone number, please stop. Always use a second email address, not your phone number, because if you get SIM swapped, it just ruins your life for about a month. So back to this point about fiat currencies, digital currencies, and cryptocurrencies. Fiat currencies are on the path of extinction. They eventually will turn into digital currencies. They won't have paper, we won't have electronic, we'll have true digital assets. Cryptocurrencies will continue to ascend because they are superior. They are deflationary currencies as opposed to inflationary currencies. They increase in value as more people use them. So they actually are a better store of value. And they won't be all of our capital, because what's going to happen is ultimately we will have digital currencies in fiat because we live in the countries in which we live and we need to transact in the currency of the realm. But imagine a day when you're in your autonomous car and you're in the back, you don't ever drive again. You're in your autonomous car and it pulls into the quick charge station. And it won't take hours, it'll take seconds. You will not get out of the car and whip out your plastic card and put it in the machine. The car, using cryptocurrency or digital currency, will pay the charging station. And then it will pull away and you'll get into traffic and you'll say, I don't want to sit in traffic. I want to go in the fast lane. It won't take a picture of your license plate and you write a check and send it in. The car will pay the lane and you will zip on. And so all of this interconnection, when everything's connected, right? When we have the Internet of Things or the Internet of Everything, then we couple that with the Internet of Value, which is where this whole Fintech conversation comes in. And then all the ancillary services, right? Managing digital assets, right? The digital asset management industry is in its infancy, but is going to be monstrous. I mean, monstrous, because the scale and the opportunity set is so big. Digital financial services, our biggest investment, is a company called BlockFi, is a bank. That's all they are. They're a bank. You can't call them a bank because the banks get really pissed off. But what do? They take deposits and they make loans in digital assets.
So Mark, just go back for a second. Let's talk about, and I think you're heading in this direction. What sectors? Now, we covered a series of them, right? We talked about financial infrastructure, financing, banking, et cetera, et cetera. Let's talk about, I'd love to hear your views on which ones are ripe for opportunity right now. Which one of those sectors, or which ones of those sectors?
So look, banks have been under assault for a long time, and fintech is really winning. Think about where you would go to get a home equity line of credit. You're not going to the bank, right? You're going to Figure. Where would you go to get a mortgage? You're not going to the bank. You're going to Rocket. Where would you go to borrow money for an emergency? You're probably not going to the bank. You're going to a peer-to-peer lender like Lending Club or Lending Tree. So fintech has really already disrupted the banks. Now, banks will have a role, right? What are they good for? Well, they're good for security, right? People still trust them. They're good for record keeping. They're good for transactions of certain size where you still don't feel comfortable in the new realm. So I think they'll play a role, but they're definitely under attack, and fintech has really done a lot there. In terms of investments, we're just at the beginning, but we're at the beginning of an absolutely extraordinary journey. If you think about TradFi, traditional financial services, and you can just put investments and insurance kind of lumped in together. And then you go to CeFi, which is centralized new financial services. So that's BlockFi, where BlockFi or Coinbase. What does BlockFi do? I said they're a bank, but they're a centralized digital bank as opposed to a traditional brick and mortar bank. But they're not decentralized. So the next step, and this is the big one, is DeFi, which is decentralized finance. And that is where literally everything we all think about, right? That we all work in this industry and different parts of it, is humans. And as Mark Andreessen said, software is eating the world. Well, software and code and smart contracts are coming for all of us. And that's everything from, lending to borrowing to, deposits and asset management, right? If you think about traditional asset management and an analyst working on a stock, the analyst is way slower than the computer.
Yeah.
It is way less comprehensive. Computer algorithms today, artificial intelligence, machine learning can analyze far better and more comprehensively than individuals.
Okay, Mark, before you go forward, there's a question from the audience. Smart contract. Can you define that,
smart
please?
contract. So smart contract is an Ethereum-based piece of code. And it essentially, as the name implies, so you and I make a bet, and I'm infamous for this, right? I'll bet people all the time, and I'll say we bet a steak dinner. Now the event happens, and I lose because I always lose, and I owe someone a steak dinner. Well, the problem is you got to find me, you got to collect that steak dinner, and what a smart contract would do is say, all right, Mark and Bob made the bet on this day. Super Bowl happens. Mark's team loses. And his Bitcoin account gets, credit, and it sends the Bitcoin to Bob. And so it instantaneously settles with code. Now you extend that idea of a smart contract to derivatives. How about options or futures? I've personally invested in a protocol that essentially could displace all of structured finance. And if you think of all the things that structured finance on Wall Street does through paper contracts and lawyers and all this stuff,
right?
We could do it with code and contracts that are inviolable and perfectly executing and not subject to the foibles or fraud or I forgot to sign exactly the right place.
So Mark, is a smart contract what would be visible? To go back to your example before, when you decide you want to go into the fast lane and go 90 miles an hour, and so the sensor would detect some unique identifier for you. Is that the smart contract?
So that's an example of the driving lane is more an example of a payment, right? A payment rail. So I'm going to
how do they know it's you, right? So there's something, the mark of the beast in a sense, right?
Yes.
So all of us will have the mark of the beast, right?
Yep.
And what is that called in this whole milieu?
So digital identity, I guess digital identity probably, and this is where I'm a little out of my depth. I'm not a tech person by nature. I'm a financial services guy. And so you might be right, Bob, that the actual identity portion, right? The trigger that says, yep, that was Mark's asset and it was in his account and it went from his account to the other account. There probably is an element of smart contracts in there. And
okay.
But at the end of the day, the way I think about smart contracts is think of paper contracts, whether it be a derivative contract or a note to buy or sell, or a transaction that needs to be executed at a future date. And rather than relying on somebody's tickle file on their calendar to remind them to do it, or it literally is in the code, it's embedded in the code, and the protocols, primarily Ethereum today, most of these things are based in Ethereum or related protocols that are linked to Ethereum. But ultimately, back to, and for a second, so it's really not smart contracts so much as that identity comes from the mining. And mining is an unfortunate term. Why they picked that term, I don't know. Because what mining really is computing power. Think of a data center. A data center, the model is you buy computers, you plug them into power, and then you have to go find customers to buy your computing power. What mining is you take computers, you plug in the electricity, and then the algorithms use the computing power to execute. So if I have a token, right? If I have a Mark coin and I want to send that Mark coin to you, we have a computer network that says, three things. One, Mark has a Mark coin and it's Mark's. Two, he sent it to Bob and now Bob has it. And three, it's safely in Bob's wallet and now it is indelibly and 10 minutes later, permanently in Bob's possession and Mark can't have a claim on it. And the real innovation there was solving what's called the double spend problem.
Okay.
So as you go from analog to electronic to digital. So the easiest example is music. So you and I remember physical record albums, right? An analog thing, right? We put that analog black disc down and we put the needle down and we heard music. So then Michael Dell came along, not Steve Jobs. Michael Dell came along and invented the MP3. I actually don't know if he invented the MP3, but he had the first MP3 player.
Okay.
And it was just a bad form factor, and Jobs out competed him with the iPod. But the bottom line was, now I had a song. I'd now converted that analog song into an electronic file. I want to send you that song. I could make a copy of it. I could send you the copy, and you don't really care if it's a copy or the original because it plays just as well. Now, who cared? The music industry cared. And how much did they care? They cared so much that they went and arrested Sean Parker at Napster and blew up his server, right? Because to stop a centralized system, a hierarchy, there's a CEO and there's a server or home office. And you can arrest the CEO and blow up the server. And I don't mean commit terrorist acts, but that's how you stop a centralized organization. If it's a decentralized organization, if Napster would have actually existed on nodes all around the world, they couldn't have arrested anybody. It's like the joke when Zuck went to testify to Congress on Libra, now Diem. And the joke was, well, they subpoenaed the CEO of Bitcoin, but they were unavailable because no one knows who they are. So what ultimately, when you go with money, right? If I have a physical dollar, and now I don't have physical dollars. I couldn't find a piece of paper money anywhere in my house, probably. And I have electronic money. And I do have a recurring nightmare about this, that I go to the ATM and it says zero. How would I prove that it's not zero? I don't have physical statements anymore. It's their word against mine. They're the trusted third party. But there's a lot of trust in those institutions that my money is my money.
Well, why wouldn't you do it the same way you do it with a brokerage account today? As you indicated earlier, we don't hold stock certificates anymore. We don't have evidence of ownership, right? Yeah. So you get a monthly statement, you get a confirm, and there's a certain time frame within which you should be checking those documents.
Amen. And do we do it? You do. No, I don't. But it's bad. So what? But the problem is, if I convert that dollar to electronic. And this was the problem for years. We had eCash, we had Digital Eagle. So there were all these attempts to make electronic money digital. And the problem was this double spend. So I would just make a copy of my dollar and send it to you. Now I'm a fraud, right? I'm a money launderer. So the problem is what Satoshi, whoever he, she, they are, created. And this is, and I don't know how to state this with the enormity of what it is, other than to quote Eric Schmidt, who has a lot more credibility than I do. And Eric Schmidt said, the ability to create a digitally unique asset is incredibly valuable. And a lot of companies are going to be built on that idea. So the idea that I can make a dollar unique in terms of a Bitcoin, and that I can convert that fiat into a Bitcoin. And now it is a unique asset that I cannot make a copy of, because all the people on this call who run nodes would say, nope, Mark's cheating, okay? But once I transfer that identical real asset, unique asset to you, the nodes say, yep, that's good. That genius.
Yeah.
And the incentive system through mining, which is securing of the network, to create what is today. This is amazing. How many times everyone on this call had to get a new Visa number because of fraud?
Sure.
Plenty of times, right? Here's the crazy thing. Why? Because Visa every day gets attacked 30,000 times. People trying to hack into Visa, steal the number, steal the people's money. 30,000 times. You're like, well, Mark, how do you know that number? You're just making it up. No, my son was the auditor for Visa in his first job, which he hated. But that's how many times? 30,000 times a day. And sometimes they're successful. So here's the thing. Bitcoin has been in existence for 12 years. not one fraudulent transaction.
Yeah.
How is that possible?
Mark, something you're saying here is very interesting. You're talking about, so the financial system, and I'll take securities in particular, up to this point, has put a premium on assuring fungibility, right? You're suggesting the exact opposite for the future. Okay.
Yeah.
But unique yet exchangeable.
Unique but exchange. Right. Brilliant insight. And to that point, the only way you can do that is if you're perfectly secure. And in computing, you have a choice. You can be fast or secure. Visa is fast, but they're not as secure. Bitcoin, hundreds of millions of transactions, not one fraudulent transaction, perfectly secure. It's because it's the most powerful computing network on the planet, right? 1,500 times more powerful than the CERN supercomputer. Most powerful computing network on the planet, full stop. It is the most secure computing network on the planet, full stop. And it allows that unique exchangeable asset. And it's why it is the fastest asset in the history of the world to $1 trillion of value. I mean, just is faster than Apple, faster than Netflix, faster than Google, faster than Amazon, faster than all of them. I mean, it took IBM 40 years to get to 100 billion in market cap. It took Bitcoin 7 years. And now 12 years later, it's at $1 trillion. So that growth says that we're on to something, and that becomes the base layer for all of this disruption. So you ask the question of what areas are most ripe for disruption. Banks have been under attack for a while. They're going to get disrupted, but they're not going away anytime soon. Payments, big time disruption coming. Yeah. Huge disruption coming. And look, the payment companies have all figured it out. PayPal, all these things, they're starting to play in Bitcoin and cryptocurrencies. And they're figuring out, we have an investment with a kid. He's a kid. I mean, he's 26 now, so he's not as young as he was when we invested with him. But he's built technology that will allow you to convert fiat money to any other fiat in the world instantaneously for free over the Bitcoin network. How big could that business be?
Wow.
It could be big. Now, it could flag, right? Visa or MasterCard, somebody could figure out another technology that does better because they already have the installed base. But in the same way that Visa, which started as an experiment by Bank of America in one town in California, think about that for a second, has become the dominant payments rail. This idea could become the dominant payments rail on this Internet of Value protocol stack. Yeah. And that level of disruption is mind-blowing because you think about the size and scale and scope of the payments industry around the world.
Fascinating. And I just want to ask a follow-up question. What happens, and I'm sure someone's thinking about this, what happens when someone basically cracks into this computer?
Yeah.
Okay.
The quantum question.
Right. So, and I know you're familiar with the concept of electromagnetic pulse, right? So EMP for Bitcoin, someone cracks in, and to go back to something you said a moment ago, since there's really not a lot of records about who owns what, right? The fact is that the number of Bitcoins suddenly go from whatever it is right now to a factor of whatever, some number greater. The system comes crashing down, no?
Yeah, well, so two questions there. So one, the supply of Bitcoin, it's in the code. Yeah. It can never be changed. That's not true. It can only be changed if 51% of the network, of the nodes know about it, decide that they want. But here's the thing: whoever he, she, they are, whoever Satoshi Nakamoto is, and there are lots of great theories, right? If you type Satoshi Nakamoto into Google, you get Google Translate, you get Intelligence Central, because Nakamoto is the name for people from the central part of Japan, and Satoshi is the term for intelligence. That sounds a little like CIA to me, Intelligence Central. Second is that it's Samsung, Toshiba, Nakamichi, and Motorola. That one's kind of cute too. There's others that it's the Chinese government or but whatever. I actually believe it was 4 people, one of them being Hal Finney. He passed away, unfortunately. But the bottom line is whoever he, she, they are, the genius, the absolute genius of this one thing, which is incredible. Everyone says, what about the 51% attack? What about the 51% attack? What about people changing the rules? What? The moment you change the hard supply cap, the value dissipates. The moment you do a 51% attack and steal somebody's Bitcoin and violate the inviolable nature, it goes to zero. So you've removed any incentive for theft, for pilferage, for changing, and it boggles the mind because you sit here and think, no, that's not. Oh my God, that's exactly right. You can't do the bad stuff because you make the value go to zero, and so you would have stolen a worthless asset. Now, on the quantum question, look, there's one computer in the world. As far as I know, maybe there's two, but one that I know of that is capable of quantum computing as people talk about it, which is the states.
Okay.
The problem is it has to be stored at like minus 47 degrees, centigrade or something, with liquid nitrogen. And more importantly, today it can process about as quickly as the original 286 computer I bought from Michael Dell from his dorm room back in 1987, which I literally did, and I should have kept it as a collector's item, but I didn't. PC's limited. So the problem is that computer's not cracking anything. And everybody says, oh, but it's coming. Well, here's the thing. Should there be a quantum computer and you could bust the Bitcoin model, there's $1 trillion of value there today. That might not be my first target. I might go after the Fed. I might go after, China. There are probably some other targets before I get to Bitcoin. So, and the third part is there's actually someone who raised $100 million to create the antithesis of a quantum computer to install the new tech, the new cryptography. Because remember, all crypto means is cryptographically secure.
Yes.
And it's got this negative connotation. It's kind of like when you say introverts and extroverts. People think, well, introverts are boring and extroverts are cool. That's not what it means at all. Introverts recharge their battery by being alone. Extroverts recharge their battery by being with people. That's all it means. So crypto as a word simply means cryptographically secure. And cryptography has been around for a long time, all the way back to 1988, Tim May, the Crypto Anarchist Manifesto, which is why we have this whole movement. Took 20 years for it to catch on from 1988 to 2008 when Satoshi Nakamoto came along. And it's because Tim May was an anarchist, right? And he sat up in the mountains with his guns and he didn't have any friends. So he didn't influence anybody, but he wrote this beautiful thing that laid out everything that would happen over the next 30 years in 1988. But cryptography has scaled to create what we have today, which is a perfectly secure network, the most powerful computing network on the planet. And my guess is the technology will continue to advance. So if quantum is created, but who knows?
Well, Mark, unfortunately, our time has come to an end, and I think we could go on for hours talking about this. And so, on behalf of the roundtable, I want to thank you for really the most thought-provoking and interesting conversation on fintech. Really, really, really fascinating. And I think everyone can see Mark's. We got some contact information up there on the board. So by all means, folks, if you'd like to reach out to Mark, we would encourage you to do so. I know he would. So again, Mark, I really, really want to thank you. This was fabulous.
No, thank you. It's always great. Conversation's always better when the host is well prepared, has thoughtful and insightful questions, and keeps the conversation moving and doesn't let me go into, I would say I don't do short well, but I really love this topic. I love that, we're all in a space that on first blush can be a little daunting and a little, we can all be a little fearful that we're under attack, or we're under assault, and our jobs are going to be dislocated, and what are we going to do? And the answer is, innovation has always led to more jobs, not less. We have more jobs today than we've had at any time in history.
Yes.
And we will all, if we embrace the change instead of fighting it, we can all find ourselves in a great place. So I'm excited to see what we all do together in this space in the future.
Amen. And thank you so much for your insights. And I do want to thank the audience. And I do also want to remind everyone that on the 26th, we have a very interesting discussion on the implications of GameStop. So for more information, please go to the website. And I guess on that note, I'm going to say bye for now. And again, Mark, Yusko, thank you so much for your time and your insights.
No, thanks, guys. Really appreciate it. Thanks to
Be well.
NYAIR, and everybody have a good rest of February.